Good morning, I'm Simon Brown, host of MoneywebNOW and hosting the first session of the Moneyweb Better Investment Conference. As Craig said there, we've got 2 days of guests. I'm kicking off. I've got Tshepo Modiba, Craig Gradidge. We're going to be talking mechanics of investing. It's been a tough 2022 so far, and I think in many senses that's as good a reason as any to maybe go back to the basics, good to revisit some of what we need to understand around investing, what we should be looking for. These are the sort of questions we're going to be delving into. Also, we're going to touch on what do we do about some of those stocks in your portfolio which really you're wishing you'd never met and you'd never bought at all. Is there anything we can do perhaps beyond just selling them and moving on from them? But let me introduce my guests. Tshepo Modiba, CIO at Cannon Asset Managers. Tshepo's been in the industry since 2007, Seriti Asset Management Advisories and Capital. Also spent some time at Investment Solutions. And Craig Gradidge, co-founder, executive director and CIO at Gradidge-Mahura Investments. Craig's been in the industry since 1996. Gents, welcome to you both. You both came into the industry, excuse me, shortly before collapses, Tshepo 2008, Craig 1998. I remember 1998, the Asian tigers and the like. Craig, what we're seeing in the market at the moment so far this year is kind of what markets do. I mean, I know it feels new because we haven't had anything in some time. We've had a decade of low inflation, low rates, quantitative easing, but really selling off in bear markets is just stock markets.
Yes, good morning, Simon. Good morning to the listeners. I think, what we see is nothing new. The reason why the markets are falling at the moment may differ to previous crashes,
Sure.
But it's a function of how markets work. A bit of excess builds up over time, and reality strikes, and a lot of that enthusiasm comes out of the markets, and markets start to fall. So there were a lot of excesses in the last, I would say, particularly the last 2 years post-COVID, low interest rates. So people were disincentivized from investing or keeping their money in the bank. If you're looking for yield, bond yields were quite low. In fact, at one stage, the majority of global bonds, or at least I think 50% of global bonds, were offering negative yields. Something we haven't seen, or I certainly haven't seen, in the 20-odd years I've been in markets. So when you have those sort of that sort of environment, it's expected that you'll see equity valuations run way ahead of where they should be, and now there's a bit of pullback.
Tshepo, the pullback's not bad. I mean, it's scary. I was saying to you before we came on, at least we're all in the same boat. This isn't, even the crypto folks are taking some pain, and we're going to have a bunch of sessions on crypto later today. This is, in the classic sense, opportunity. And I know it's easy for us to sit here and say that, but to Craig's point, I mean, there were some stocks out there, particularly I'm thinking the big tech in America, which really were at what we can politely call lofty valuations. A bit of normality and a bit of sort of common sense return into the market maybe makes it a little more harder, but a little bit easier. Harder in the sense that now we've got to go and pick stocks rather than just buy the new tech stock. But easier because now there's some stocks at valuations we can get our head around.
I think that makes a lot of sense. I think to your point and Craig's point, the market continuously is a playoff between, I guess, two underlying themes. The first being mean reversion, which is that markets at some point revert back to long-term averages, and then structural changes, which is almost the exact opposite. And when assessing a stock, a company, a sector, you continuously have to balance off those two factors. And big tech over the course of the last decade is exactly that. The reality is, operationally, those businesses have done phenomenally well, and have warranted investors to pay attention and for them to rally. But to your point, the markets overreact one way or the other. And in this environment, if you have the stomach for it, it does present opportunities to look at some sectors that have traditionally been overlooked. Well, I say traditionally, over the course of the last decade overlooked. And some companies where I certainly didn't think we'd get the opportunity to own.
In the price. I want to touch on your point around mean reversion, and I get the concept around it. Does it mean that the returns of the decade ahead, and I appreciate that a decade is a long time and the future is unknown, but theoretically does it mean that the decade ahead we're probably going to see lower returns than we saw in the past decade, particularly if we're starting to see rates rise, which means there's an opportunity for me to go into good old-fashioned cash and earn some return there, whereas for much of the last decade, certainly globally, you weren't?
I think it really is a function of where you look, right? So I think the pockets of the market that have done well over the course of the last decade, is there scope for significant rallying in that going forward? Perhaps not. But as always, the market is quite broad, and depending on where you focus, there's businesses that are likely to do well, and markets indeed.
Okay, so I suppose it comes to the point that there's always going to be some opportunity. The job perhaps to find it is to find it. Great, let's sort of go right back to the beginning. Principles investing, that surely starts with having a plan, having a strategy, and that will be broadly the same for everybody, which is, put some money aside every month, but of course going to be nuanced as to your own personal circumstances. Perhaps kids heading to school, perhaps nearing retirement, perhaps a first job, but having a long-term plan in place around the stock market and ultimately that wealth creation.
Yeah, that's the starting point, is to have understand what it is that you're trying to achieve from your investment. Because ultimately that will determine the strategy that you need to adopt to achieve what you're trying to achieve. So your money needs to serve you and to serve the lifestyle that you want and to help you achieve the objectives that you have. And that's the one thing we find with a lot of investors when speaking to prospective clients for the first time. You say, well, I've got R1 million to invest. And you say, okay, great, what do you want to achieve with it? I don't know.
2 million.
Yeah. So it's that whole, I think the SMART acronym is what people use to define their objectives. It must be specific. Is it for retirement? Is it for kids' education? As you said, is it for a trip around? Whatever the case may be, needs to be measurable. It needs to be achievable. It needs to be realistic. I've had somebody email me and say, they want to achieve R1 billion in the next 10 years, and they were starting out with R100 a month.
Look, I like the ambition.
Yeah, no, look, you can't fault them on that. And then it's got to be time specific. So a lot of investors don't spend very little time on that. So as a result, their investment strategies become a bit messy. So they kind of go whichever way the wind is blowing. And then the principle of diversification. Diversification, even if you're investing in one share, you can apply the principle. You could buy a Remgro, for example, which is a diversified entity. So you would start there as a beginning point, as opposed to buying Thungela, which is invested in coal. But that's the way the wind is blowing at the moment, is the Thungela way. So the principle of diversification, critical. And it can be applied in any circumstance. Then I think a long-term investment, and that refers to the mindset that investors have. But truly understanding what taking a long-term means. Again, when you're in this game long enough, you come across anecdotes. And I had a call from a client, well, no, she wasn't a client, from a lady the one day who was very upset with her returns. After some digging, I realized that she was invested in cash in the money market, and she had been there for 20 years. But to her, that was taking a long-term perspective, because, She invested where she was getting a good return. 20 years ago, cash was giving fantastic returns. However, the long-term perspective was completely misplaced. For over 20 years, she would have done significantly better anywhere else. So, again, it's understanding what does it mean. It's when I'm making a decision today, what gives me the best result over time, not what gives me the best result over the next 2 or 3 weeks. So, for income investors, very often they look at the highest yield that they can get. And typically that's in an income solution, in an enhanced income type fund. However, if you look over 20 years, they'd probably earn more income from dividends over a 20-year period than they would from an income solution. But then what does that mean? It means accepting the volatility of equity. But they still achieve their investment objective. So I think those are some of the basics, is understand why you're investing. Apply the principle of diversification, take a long-term perspective. And I think that actually helps solve a lot of the challenges investors tend to face.
And it's also, I remember someone contacting me a few years ago. They had a long-term, they had some money they wanted to put away for the long-term. It was 3 years. And I'm like, I don't know, where I come from, that's the short-term, long-term is decades. Tshepo, you're managing funds. Growing up in the 80s as a kid at school, learning about markets, we talked about these bottom drawer stocks. You buy Disney, or General Motors was a favorite, and of course that didn't survive 2008. And you put it in the bottom drawer and you leave it for your grandchildren. On individual stocks, is it still possible to do that? Or I appreciate within a fund. Craig's talking a fund, you manage it, but is there still going to be that opportunity? I imagine you monitoring it on every time results come out. But how much sort of change is there happening within the funds that you manage?
I think it really is a function of individual stocks. You mentioned an important point there, which is that you need to monitor it. There's a balance of considerations. Earlier I spoke about mean reversion versus structural change, which are almost opposite factors. But similarly, with looking at a company, you need to be prepared to own it over the long term, but you need to monitor it continuously to assess whether anything structurally has changed, or not even just the company, but your investment strategy overall, to see whether something structurally has changed and it warrants fundamental changes. In terms of items such as companies that you may invest in and keep in the bottom drawer, there are those companies. We, as an example, we spoke about big tech for a while. We've been invested in Microsoft for well over a decade. But fundamentally, the business has changed over that decade, and we've continuously monitored it. So it hasn't been a case of we've bought it, kept it in the bottom drawer, and not looked at it, because the business itself has continuously evolved. So I think just given the change in technology and the rapid change in economic realities around the world, I don't think it makes sense to just buy and hold for 20 years anymore. You really need to assess continuously each investment that you take, because things can change quite dramatically.
That's a great point. At Microsoft, the change is there. 10 so years ago, under Steve Ballmer, Microsoft was selling software, and that software was Windows and Office. Windows is now free. I think I subscribe to Office for $100 a month, and that gives me 5 licenses. They've brought on Azure, the cloud. They're bringing in AI. The Xbox has suddenly become so much more significant. There's been structural changes, but they've been in a positive sense rather than perhaps in a negative sense.
For sure. And it could have been, and it was the reality of Microsoft probably until 2015, that any changes that they were looking to implement were actually negative. And with the change in the management team, that has facilitated positive change. I don't want to hop necessarily just on Microsoft,
Sure.
but the point remains that if you don't continuously assess your investment strategy, whether you invested in equity, whatever it is, it needs a a robust ongoing assessment, hopefully not daily, but a clear-eyed assessment of whether that particular investment still meets the criteria that you used to go into it.
Craig, I'd imagine this is the same in an individual who would perhaps come to you, a prospective client or a client. Their circumstances may change. They suddenly have kids, twins, triplets. They get divorced or married or whatever the case is. You want an overall strategy that kind of encompasses that, but they're going to be small little points during a lifetime which maybe are going to suddenly you need an education policy or something.
100%. For us, our refrain to clients often is, we're not changing your portfolio because markets have changed.
Yeah.
We're changing your portfolio because something on your side has changed. Like you say, there's some kind of life event, and that life event necessitates a review of the strategy and what needs to change there. So typically, your investment strategy, if you've set it up properly at the start, it's really a change on your side that should change your strategy or your plan.
Probably smaller, if it's properly set up, the changes are perhaps more tweaks than giant overhauls.
100%. So you refine your strategy, so the new reality that's there, so the strategy has to help adjust to that. But on an ongoing basis, the market should never be a catalyst for a change in strategy, unless, as Tshepo said, there's a structural shift of some sort. Then you, but that you would do with the annual review of your portfolio, or whatever period you choose to review your portfolio.
I want to delve into the research process, and it's going to be different for each of you because you, Tshepo, are running funds, so you're looking at the individual stocks. You, Craig, are putting clients into funds, so you're not looking at the stocks, you're looking at the funds. Let's start with you. I imagine what you don't do is get a list of prospective investments and sort them by return over the last, quarter or year or something like that. That's nice, but there's a much deeper process you're going to go into to if a fund meets the requirements for you to recommend it to clients, which is returns important, but there's so much more to it that I suspect it's on your list, but it's probably down the list.
Yeah. So our starting point is to filter out the rubbish. Because that's half the challenge.
So how do you do that part? I appreciate that. That's easy said.
Yeah, so you got to understand the various metrics that So for one, funds with kind of highly volatile returns, very expensive funds, so fee structures that don't quite make sense. So you start there by just filtering out the rubbish, because then it reduces what you need to spend a lot more time digging into. So again, we very expensive funds we take out. We look at a volatility of returns compared it to the sector and see, why is this one so far away from everybody else? Are they trying to be cute, or is that their strategy? What does it mean? So typically we tend to avoid funds like that. And then when you're left with kind of funds that meet your criteria, you start digging in, how do they manage money? What's their philosophy, their process, the people, pricing, all of those issues. And then once you filter down to a smaller set, so we've distilled the number of funds we offer to clients to about 35.
Wow.
And that's out of a pool of over 2,000 funds. And then in terms of structuring a portfolio, we need to understand how various funds work together and what kind of sort of correlations are we looking at. So when I structure a portfolio, that portfolio needs to be quite robust. So we have, in every portfolio, we have active and passive. Okay, those are not religions, they're not football teams. We do not have to choose one over the other. Passive gives me strategic asset allocation, it gives me low pricing. Active, I'm looking for kind of sound, pragmatic philosophies that generally have stood the test of time in different market conditions. And then ultimately I want a portfolio that will produce the desired return at a level of risk that I think the client will be comfortable with.
Risk and volatility. Quick point, folks, if you've got questions, send them in, events@moneyweb.co.za. You can send your questions for either Craig or Tshepo. I will put them to them. I've got them coming on my phone as and when they come through. I quickly want to touch on fees. The fee debate, probably when you were starting some 25 years ago, probably was hardly not there at all. It's become important, but I like your point around religion. It almost, I mean, yes, there are high fee funds out there, but we oftentimes we're arguing over 0.5%, which, you know, frankly, always rather in my pocket than somebody else's. But it's almost a debate which has been, which has moved to the low is better, and we've got there. We've got that range available.
Yeah, so fees alone is not a fault. You don't filter out based on fees only. So we do have one or two funds in our range that are expensive, but that cost is driven more by performance-based fees.
Gotcha.
So they do make it through the filter on their base fee. And then you got to monitor the manager over different market cycles to understand their philosophy applying in that. So we don't hold it against the manager if they have a performance-based fee. We want to make sure that there's an appropriate hurdle in place. Sure. Some managers, essentially the first 2 or 3% of return is theirs. Those managers we're not really interested in. And we got to make sure that it's fair, because the client is ultimately taking the risk. And then it's got to blend into the portfolio and add value to the rest of the portfolio. So I think, and then our size allocation. So typically we wouldn't put 30-40% into an expensive fund, because then the fee becomes a factor. So there's a few moving parts. Our starting point is always a broad-based index or passive fund, and then we build around that.
So let's move across to you. As I said, you're coming at this completely different, because you're looking at the stocks, and that then raises bunches of questions in my head. Do you have do you come at a philosophy of its value or its growth or it's this or that? Do you do a top down and look at sectors and industries, or is it a case of stock specific that you're focusing on?
I'll start out at a principle level,
sure.
And then touch on how we go about doing it. I mean, our fundamental premise is that each investor needs to use the tools that they have at their disposal to create a process. So, by way of example, if you are a phenomenal litigation lawyer, and you have the ability to discern which direction potential litigation is going to go, you should utilize that in your investment process to look at companies that potentially are being sued, and see whether they're likely to win the case or not. Because if you've got that skill, you can make a lot of money.
Yeah.
If you are extremely tech savvy and can discern between which app, as an example, is going to do better than the other, you can utilize that in your investment process to gain an edge, as you touch on. So I think, as a principle, investors need to use skills that they have at their disposal, rather than copying what everybody else does, right? Use what you think you've got an edge in. As a business, we've put together a team that has quantitative backgrounds, has traditional investment skills in terms of economics backgrounds and finance backgrounds, and we utilize those tools to help our decision making. A part of that is building models that can discern which sectors are likely to do well going forward, but then we do our fundamental research into it to to understand the drivers of earnings and returns for a particular company and base our investment views on that. So really what we then blend is a combination of skills to produce sustainable, repeatable investment process and hopefully returns.
And you're looking, and I get the sector, and it's broadly, I'll look at a sector and think this is a good space to be in. And let's look locally, food retailing, for an example, people are always going to be eating in tough times and bad times. I like the space. I then drill into to the different stocks and dig through them to come to one that I like. Mm-hmm. And then I keep an eye on all of them. Because I might own this one, but what's happening there might be a forewarning to what's going to happen here. Maybe they're taking market share. So it comes back to that bottom drawer most in a sense. Yes, you've got the stock you prefer. Yes, you've got a position in it. You're monitoring it, but you're keeping a picture or an eye on the sector generally as well.
And I think an important point for us is that there's a fundamental difference. I know this has been said, but there's a fundamental difference between a phenomenal company and a phenomenal investment opportunity. Yeah. So just because a company is sector leading and it's phenomenal in terms of what it does, a lot of that can be built into the price. And what we try to do is understand the business for what it is. If it's phenomenal, we'll give it credit for being phenomenal. But we're very pragmatic in terms of what that means from a valuation and an underlying value for that business. And how we drive our investments is really that value versus what the market is pricing it. So how we think we make money is that differential between expectations and our version of pragmatic value.
So you could find a truly superb company. The valuation doesn't work. It's just superbly priced. Do you then walk away?
We walk away. As you touch on the big tech businesses, I will stand on this. They are phenomenal businesses. They are game changing in terms of how each of them has gone into the market. I do have concerns around Netflix in particular, but beyond that, they are each phenomenal businesses. The question is, are they each phenomenal investment opportunities? We think Microsoft is, but perhaps the rest, from a pricing perspective, have gone. Expectations are far higher than what we believe the company can generate.
Then when you start digging into the weeds, and I'm thinking, and I know we chatted maybe a decade ago around discount cash flow, and I remember saying to you at the time that there was so much input into it, and there was every one of those inputs, the risk is me. The risk is me making a mistake. And you concurred, but your comeback to me was, but it makes you think about the business so much more, because the little nuances that go into the DCF, the discount cash flow. And then when results come and there's you were wrong, that gives you a space to go and say, well, that part I'm obviously not full in control of. Let me dig into that.
I think that's ultimately everybody who buys any stock, irrespective of how you arrived at the decision to buy it, you are either explicitly or implicitly taking a view on the operational outlook for it.
Yeah.
It's just a matter of fact, right? What we prefer to do is be explicit around that. That way we can have a regular audit as to whether we were right or wrong and what drove the decision to, what made us right or wrong. And we think that then allows us to refine our investment strategy to hopefully be less wrong.
Yeah, and get smarter around the strategy, but also around the business. Craig, will you look at a fund perhaps and see a stock, maybe their biggest holding, a 10% weighting, and think and almost second guess the managers? Or do you say, I've done my analysis of this portfolio, of these managers, and I need to trust them at their story?
Yeah, that's exactly it, Simon. We don't second guess the managers. So our job we've done. And then we leave it up to managers to get ahead with the job of managing money. There's a saying in the market that passive is an active decision because there's so many choices between different passive funds. By that same logic, active would then be a hyperactive decision. Because then I would need to go into managers, into funds and look at what they're holding and make a call on that. Then I might as well, park all the other work that I'm doing and just do the manager's job. So no, the reason we would choose the managers because we think they could do the job better than we can.
Craig, you mentioned that you start with 2,000 plus funds, you used to still it down to 35. Tshepo, you've got a whole bunch more. Certainly in the local market, it's a couple of hundred for a fund, but as soon as I step out, you're talking tens of thousands. I mean, do you have a process which lets you limit that down? I mean, is it you mentioned certain sectors that you like or themes that you're interested in, or perhaps just a search and you can say, show me stocks that are only 2 times NAV?
This is where I go back to my starting premise, which is to use the tools you have at your disposal. And one of those, we believe, is strong quantitative skills. So what we've done is we've built models that allow us to assess regions and countries for countries that we like. And within those countries, then we have a way of ranking stocks based on the sectors that they're in. And that's how we narrow the universe from 12,000 odd stocks that meet our size and liquidity criteria around the globe to a manageable subset that we have objectively filtered. Because the important bit of investments is your biases as individuals come in. And if your process, if you're not conscious of the biases that come in, you can underperform and not be aware of why you're underperforming, but it's really your underlying biases. So in narrowing our universe, we try to remove those biases as much as possible.
And I imagine part of being a team as well, and for many of our viewers today, they're not a team, so they need, and that's what I think is the beauty. And I always did it where I would get fellow friends who could critique me, because we have blind spots. I remember falling in love with Sasol once, and I had this giant thesis as to why. This was when it was $16 a share the first time, so we're going back 30 years. And I had this giant thesis, and my friend just destroyed it in like 5 minutes flat. And it turned out I should have bought it because it did go up. But nonetheless, a great question coming through from Darren. Tshepo, for you, how do you distinguish structural changes in a company, which we were talking about, versus the need to change to the environment that's changing? And what I mean by that, we are entering a quantitative tightening rather than easing. So the easy money is going away. We've got inflation in developed markets for the first time in, 40 years. UK came in at 9.1% this morning. Those sort of fundamental changes, there are going to be some businesses out there which need to change their business model for this new reality which faces.
I think that new reality goes back to your first point that you highlighted, which is that markets and economies always feel like they're structurally new, but in reality, we've seen it before. And I think history is a great gauge of how businesses react in certain environments. So have we seen a high inflationary environment before? Yes, we've seen it in the 70s and the 80s, and there's learnings to be had for how different types of businesses behaved in those periods. And I think that historical anchor is a great reference point to give you a gauge of whether a business is or has to go through structural changes, or if it's actually whether they have to or not, whether they're likely to go through structural changes is the more important part. Because I think what we also need to remember as investors, it's not about what I think the business should do, that's what the business is likely to do. That's the important bit.
Craig, a great question coming from Cuba, and he's making the point, and he says, investing certainly used to be for the elites, and I was talking before we came on air, my first trade, and we're going back to the 80s, I only got a stockbroker because my grandfather basically leaned on him, to be perfectly honest, because he didn't want this kid with a couple of $100. That has changed. I mean, everything from just the minimums for my monthly payments to platforms where it really has, you can now come with a couple of $100. You don't have to arrive in your Porsche.
Yeah, and technology has made that possible. Yeah. And technology, there's the structural change that comes from the previous question, is understanding these changes, how do they apply in different markets? And that is why you could have something like easy equities, really take that technology and apply it to solve that particular problem. The challenge for investors is trying to find other companies that are taking new technologies and applying it to solve other real problems. But I think, it's also understanding, what does this mean? That you've got perhaps a broader base of smaller, arguably less informed investors, and we've seen the impact of that in quite a spectacular way in the US. With I think it was a GameStop or companies like that, and so you've got this growing part of the market that can affect the market, and you've got to understand, how do you respond to that, or what does this growing investor base mean for markets?
I want to move on to managing risk, dealing with risk. Certainly we're seeing at this point, as I said in the intro, the pointy end of it. Craig, in some senses, the simple answer is, have a long timeline, have a strategy, and be diversified. You don't even, you mentioned the point of Remgro versus Thungela Resources, taking it wider, an equity long-only fund with some money market to sort of offset each other and do that blend.
Yeah, so as I said, the principles often solve a lot of your challenges. So the issue of risk, investing is inherently a risky activity because of the forward-looking nature of investing and the fact that we cannot see the future, and markets are what they call complex adaptive systems, where you think the market will behave in one way, and all you need is a small kind of change somewhere in the chain, and markets behave completely differently. Managing that risk, you've got to decide, based on the strategy that I've got and my objectives, what are the types of risks that I will face, and how do I manage them, and know that you cannot completely avoid risk. So if you avoid risk, you invest in the money market, but that introduces a different type of risk, inflation risk, tax, and so ultimately you're always managing risk. It's understanding what types of risk. So from an equity perspective, the downside risk, the risk that you could lose all your money, how do you manage it? You invest in different types of shares, so shares that respond to or react differently in a specific set of market conditions. On a single stock basis, you can buy a diversified business. You look at the correlations between different types of shares. So I think risk management firstly starts based on what you're trying to achieve, aligning your portfolio, and sometimes it's just about accepting the risks that go with that. Because ultimately, in life, you can't truly avoid risk. If I'm going to walk from here back to the office because it's safer than driving, but then the risk is that I'm going to run out of energy and not actually get to my destination.
Or you get taken up by a taxi. But I like your point. I mean, you can't avoid the risk. If you put money into your mattress, it's not risk-free because fire and inflation are both potentially coming for you. Folks, if you've got questions, 15 minutes left in this session. Send us an email, events moneyweb.co.za, and I'll put the questions to Tshepo and Craig. I've still got the one in ESG. I'm going to come to that in a moment because I think that's a great question. Tshepo, risk with you're looking at obviously at individual stock level, and we've touched on that a fair bit. Do you look at it at portfolio level as well? And maybe you find another great stock, but you think, I've got a lot in that sector already, or that space. I mean, is there a sense of trying to balance? Maybe your portfolio's too volatile, so you want some low volatile stock. Do you take that sort of holistic view at it?
We do. I think starting point is really important to define what risks matter to you, and then design a process that manages that. At an individual stock, it could be as a permanent loss of capital. So you buy something that goes to zero, right? So how do you manage that? You look at the debt levels, you look at whether you can actually trust the numbers that you're getting from them, just as illustrations of how you manage it at an individual stock level. But we definitively look at it at a portfolio level, and one of the big risks that as a business we have to manage against is we're not measured against cash or zero, we're measured against a benchmark. And part of that risk is underperforming that benchmark over a long period of time. So we certainly look at the benchmark to see how we positioned against that, whether we're comfortable with that positioning. But the premise and the fundamentals of investments come into play in constructing your portfolio. Diversification, as you touched on, that diversification is important from multiple perspectives. Diversification is, having, different stocks, but it's pointless having the same economic exposure across all of the stocks in your portfolio. So it's really making sure that you're not essentially invested in the same thing over and over again. So you've got, in a local portfolio, different economic exposures. In a global portfolio, regional diversification to make sure you're not overly exposed to a particular theme. So even though you could be looking at a South American business, you could be all exposed to what happens in China by virtue of what they do. So it's really important to drill down to the underlying economic exposure, not just where a company is domiciled.
Yeah, that's a great point. You mentioned earlier around geography, and it's an important distinction. It's not where the head office is, it's not where they're listed, it's where do they make their profit. Or perhaps they're an iron ore company and they're selling iron ore in South America, but China's the big player. You've got to be aware of that. A great question came from Jane, and I don't know if there's an answer to it, but I'm going to throw it to you anyway. How many stocks? I mean, obviously, when you're starting, it's probably going to be one or two, maybe three. You can be smart like Craig and go and do a REMGRO, which gives you some exposure to a couple of them. I mean, is there a sweet spot? I mean, that you should be above this number. And I was always told that it was between 20 and 30, and that was the number. But I don't know if that's true.
I think it depends on a few factors, and I hate giving answers. There's the famous quote around how Ronald Reagan asked for a one-handed economist because, on the other hand, right? So I'm always reluctant to say it really depends, but it does. It depends on how much money you're talking about, because transaction fees start playing a hand. So if your portfolio is small but you invested in 50 stocks, you're going to burn a lot of that, not even on just transaction fees. So it depends on how much money you're investing. It depends whether it's a global portfolio, whether it's a local portfolio. Even there, are you looking at local but a broader top 40 type strategy, or are you looking at small cap? I think it's really a function of what you're trying to achieve. But I think the rules of thumb that we try to apply on the global side, we try target at least 50 by virtue of the size of our book. And on the local side, anywhere between 30 and 40 is what we try to target. But really, it's also a function of the market environment, the opportunities that you're seeing across the broad market. So it depends.
It depends, but I take your point. And of course, there's an easy win here. Jane, if you're starting out, start with a fund, a passive or an active fund, but that immediately gives you some diversification. My portfolio is structured just like that. At the bottom is all the ETFs, and then the active sort of sits on top. A quick last question on risk, and then I want to move on. What happens when you own a stock that has knocked it out the park? And a lot of people who bought a stock 2 years ago and it is up, it's not up 1 or 2 or 3x. I mean, some of these shares are up, I'm thinking PPC, Sasol and others. These are 10, 20x movers. Do you start to sell your winner? Because I've never resolved this one, right? I bought Capitec at 20 and I've been a net seller for my entire life because it just becomes so big in my portfolio.
So for me, it really is a function of two components. I was going to say one thing, and then you literally highlighted something. It's a function of whether, as you're going along, the fundamentals and the valuation of that business still warrant a further upside. So for me, it's
back to the beginning,
and it's important to highlight that valuation moves. So what the company was worth 10 years ago will be different from what the company is worth today because the fundamentals of the business change. As it realizes that 30% growth in earnings that you expected a year ago, by definition, a year has passed, so the value increases, right? Because you're discounting by 1 year less, as an example. So it's important that you understand that valuation is an iterative process, so you continuously monitoring it and comparing it to the price. So even if it's gone up 20-fold, but you still see further upside, you should hold.
I got you.
But you raise an important point. How big is it now in your overall portfolio comes into the question of risk. Because if it's too big in your portfolio, you are overly exposed to one theme, and things can structurally change within businesses. Even if management's doing all the right things, legislation can change, as an example.
Yeah.
So
a new
that's
product, a new widget, something completely out the blue. Craig, a question came through on ESG, and there are a couple of aspects from it: environmental, social, governance. No one says it's a bad idea. Yeah. There's certainly been accusations of greenwashing. There's certainly been accusations of it stymieing innovation. There's also been claims that strong ESG gives better performance. How do you, at your firm, view and manage ESG?
Yeah, so we have some clients for whom ESG is a big issue. So for them, we need to go and find funds that pay particular attention to that. But our role is also to highlight to the client the risk of putting too much emphasis on any one issue. I think the governance is a kind of a basic housekeeping.
Yeah, no-brainer.
No-brainer. And you can lose a lot of money to organizations that are badly governed. There's a lot of emphasis on the environmental aspect at the moment. And we think it's out of our pay grade. And we think it's an issue that the fund managers that we choose need to handle. But we do need to understand and manage the client in terms of their response, because they are seeing ESG on the agenda a lot, and now they've heard that with their investments they can somehow influence this. So it's an education thing from our side. So we don't, it's not a factor in choosing a manager for us.
And then how does it play? I mean, I remember Thungela listed 20 odd rand, and there was the one argument that it was worth zero. There was the flip side that it was worth a heck a lot more. And there was also the argument that says, it's coal. Truth is that, I mean, yes, coal is dirty. No one disputes that. But planet Earth runs on coal. It probably really is a lot harder for the fund manager in terms of deciding where those principles are. In one sense, it's easy and say, you know what, we won't touch any combustion, no hydrocarbons whatsoever. Yes, but how do you handle it internally at Canon?
I think Craig touches on an important point. The governance leg is easy.
Sure. Yeah, that's easy.
The hardest of the ESG components to incorporate into your investment philosophy is the social aspect, because there isn't necessarily a formalized framework to discern how companies interact with their social environment and how that translates into long-term profitability. So it's hard to price that in. In terms of overall assessment of coal, really it goes back to not necessarily our view, but reading the policies of each individual country to assess where regulation is going to go. And if regulation allows for continual development of coal and selling of coal, then it warrants an investment in the space. If legislation is likely to result in a narrowing of that, such as we've seen in the UK as an example, then that has a material impact. And I think this is one benefit of the formalized structure of ESG, is it's forced investors to think about it and to think about the investment implications of each individual company, certainly from an environmental consideration.
We've got a couple of minutes left, Craig. Poor performers, it's going to happen to all of us at some point. In an ideal world, you've done your filter, you've done the effort, you've got your 35 funds. Some of them will have periods of lower performance and some better, because that's the design of the fund. Does there come a point where you say, you know what, we tried and it hasn't worked? And I suppose the question is, how much rope do you give them? I mean, in terms of time or in terms of performance?
Yes, I read a study a few years ago, and I've tried to find it again so I can get the details. But it was a disaggregation of the returns of the Russell 3000. So quite a large number of shares. And what they found is that the average share underperformed the index, and in fact 2/3 of the shares in the index underperformed the index. And so what that tells me is that your chances of having underperformance is greater than your chances of having outperformance. And it also shows the importance of letting your winners run, because ultimately they impact your total return a lot more over time. And the study was done over an extended period of time. So I think there's a lot of lessons in that for investors. Is that accepting that having losers is part of the game, and in fact you're going to have a lot more losers than winners. For our side, from a fund selection perspective, we don't choose sector-specific funds, for example. We'd have equity funds, broad-based equity funds, asset allocation funds, and ultimately leave it up to the manager. We look for structural changes as well. So where philosophy we think would break down. And we did have that with one of the funds where COVID was a perfect storm for that particular fund. So we put it on watch, and we haven't allocated new money to it, but it remains on watch, and because the environment will change again, and we need to see how that impacts that particular fund.
In the last minute, Tshepo, I imagine in your example, you're at the stock. You go back and revisit your thinking around it, revisit your research, reinterrogate it, check for blind spots, and truthfully to see if perhaps who's wrong here. Is it you or is it the market? Which is a big question.
It's an important point. We can't control what the market does, but we can assess whether we were right or wrong in terms of our underlying investment thesis. If we were right in terms of the operational performance of the company, then we're comfortable holding. If we were wrong, then we need to relook at the thesis.
Yeah, and it's that being comfortable with saying I'm wrong. But that's what the market does. It's a taskmaster of note. We've come to the end of the first session with Craig Gradidge from Gradidge-Mahura Investments, Tshepo Modiba from Cannon Asset Managers. For me, I think that the takeaway from this session, it's having that plan, having that strategy, and understanding the benefit and the effort of time. Time is perhaps your biggest asset as an investor. The more you have, the easier it is. And then both Craig and Tshepo, who operate in different sides of the equation, what comes through, it's about doing that homework, doing that digging, doing that filtering, using your skill set. This doesn't need to be rocket science, but starting with the giant universe and narrowing it down to a much more smaller, investable universe. My name is Simon Brown. You'll find me every morning 6:30 at MoneywebNOW. And that is it for this session. Thanks for your time today.